Hi everyone, and welcome back to A Smarter Way to Retire. I'm Tony Leonardi, your certified financial planner professional in Connecticut, here to help you navigate markets and money for that dream retirement. So I'm back from an amazing summer vacation in Rhode Island. More on that in a sec, but today we're diving into the blockbuster U.S. EU, European Union trade deal, signed on July 27th of this week. It's got a 15% tariff, billions in energy sales, and some serious opportunities for your portfolio. How do you make this deal work for your retirement? Well, let's have some fun figuring it all out. Don't forget to grab our free 2025 tax planning checklist on my website, LeonardiFamilyWealthcare.com, to help plan smarter today. Summer vacation in Rhode Island with the family, and it was a great trip. The water was beautiful, 71 degrees. Love being in New England. We had a lobster bake, surprise engagement party for my son Tony and his fiance Maddie. We also had my younger son Mark's birthday, 24th birthday in Rhode Island. It was really a great week and a great chance for me to relax a little bit and recharge my battery. So ready to get back to work. And I'm home and excited to talk about something that is almost as exciting as my vacation, exciting for your future, the U.S. EU trade deal. Let's see if we can break it down a little bit. On July 27th, President Trump and the EU Commission President Ursula von der Leyen shook hands at Trump's Turnberry golf course in Scotland, sealing what they're calling the biggest trade deal ever, according to the news. By the way, if you're a golfer, Turnberry is a must. I recommend a golf trip to Scotland. The old course at St. Andrews, Turnberry, Royal Troon, Carnoustie, it's like heaven for a golf nut. I haven't been there in 30 years or so, but I've been thinking about going back, and it's definitely on my wish list. But back to the trade deal. Here's the rundown. Tariffs. The U.S. is implementing a 15% tariff across the board on most EU exports like cars, pharmaceuticals, and semiconductors, up from an average of about 4.8% in the past, but still better than the 30% that was threatened before the August 1st deadline. You've probably heard all about this on the news. It's been big news this week, but what you may not have heard is that some sectors like aircraft, chemicals, and agriculture are actually getting a 0-for-0 reciprocal no tariff agreement, meaning that there will be no levies at all on these goods. So that's a huge win for companies like Boeing and for European farmers. So there was a carve out, which I think is pretty exciting. The EU has agreed to buy $750 billion in U.S. oil and gas through 2028, and they agreed to invest about $600 billion in American businesses, according to the White House. We'll have to keep an eye on that to see if and when that actually happens. But if it does, it will be a massive shot in the arm for U.S. energy and manufacturing. Since the deal, energy stocks like ExxonMobil jumped 3%, and small cap ETFs rallied about 2%, according to Reuters. The S&P 500 held steady at around 6,300 and change. The NASDAQ hit 20,730 last week, according to Market Screener. But European luxury goods and auto stocks like BMW dipped a little, about 1% to 2%, due to these new tariff costs, according to Bloomberg. Not everyone is thrilled. The French Prime Minister, Francois Bayrou, tweeted, "It's a day where an alliance of free peoples submits to pressure, calling it a dark day for Europe." But Germany's Chancellor Merz and Italy's Giorgia Meloni, by the way, I love Giorgia Meloni. I don't follow Italian politics terribly closely, but I think she's a great personality and a strong leader for Italy. Merz and Meloni see it as dodging a full-blown trade war, according to The Guardian. For your retirement, this deal could be a game changer. Those energy sales and investments could boost your portfolio, but higher tariffs might raise prices on European cars or a European wine that you might like. I love Europe. I have plans to go back to Italy in the fall, but over the last few years, I've leaned more towards buying American. I think the last European car I owned was about 15 years ago, and I've been buying most of my wine from California. So buy American is good for the economy. So let's see how this ties into your retirement plan. I've heard recently some talk about how the largest corporations, especially in Europe, are going to handle the tariffs. Some are saying that these companies will absorb about a third of the tariff cost, absorb it themselves. About 1/3 of the cost could get passed along to consumers, which might amount to about a 5% increase on European goods. And about 1/3 of the cost they're hoping to make up with improved efficiency through the use of artificial intelligence. It's interesting. AI is one component in all of this that we really can't measure or predict. If AI increases productivity, reduces expenses, improves time to market, etc., as it's promising, AI can potentially have a deflationary effect on prices. Wouldn't that be something if the net effect of increased tariffs and the offsetting effect of AI productivity and efficiency results in little to flat to negative inflation? That would be amazing. The jury is still out on this, but I'll be keeping a close eye on this as things progress. We really are in interesting times, aren't we, with all this AI? Let's hope for the best, but plan for the worst. I'm keeping my inflation expectations conservatively high when I run retirement models for my clients in the 3 to 3.5% range, even though we're down to 2.4, 2.7% range now in reality. I'd rather be wrong on the high side, leaving some frosting on the cake for my clients, so to speak. And I think you should do the same in your model. So this EU trade deal is really a summer blockbuster. It's got some big wins, it has some drama, and it has plenty of action for your retirement investments. Here's how it shakes out for you. The $750 billion in EU energy purchases is going to be like rocket fuel for U.S. energy. Stocks like ExxonMobil or Chevron, which could lift energy ETFs if you own them. The $600 billion in business investment could spark small cap and manufacturing stocks, especially with the business-friendly rules from the One Big Beautiful Bill with the equipment write-offs. Could be a great combination, according to Goldman Sachs. Think factories humming, small cap ETFs climbing. Now again, those 15% tariffs could bump up prices for goods, maybe $500 to $1,000 more for a BMW or $5 to $10 more for a bottle of French wine. With June's CPI at 2.7, according to Dow Jones, this could push healthcare or travel costs higher, squeezing your retirement budget, so be careful. Remember the now permanent 24 and 32% tax rates that could save you a few $1,000s per year, according to the Tax Foundation? That's extra cash to invest. Maybe invest in some of these energy or small caps that you think might benefit from the deal. Tariff revenue could be billions. According to Bloomberg, the U.S. has collected already about $100 billion so far this year in tariff revenue, with a projection of as much as $300 billion potentially by year end. Hopefully, that could help offset the deficit a little bit, stabilizing bonds and calming down market jitters a bit. That's good news for fixed income investments. This deal builds on last week's U.S.-Japan trade agreement, which sent auto stocks like GM soaring, according to Market Screener. But of course, we still have Canada and Mexico outstanding 30, 35% tariffs potentially still looming out there that could still bring some volatility to the market. So how do we make this deal a win-win for your retirement? It's time for your retirement playbook. Here's how to turn this EU trade deal into a retirement win. Ride the energy and small cap wave. Maybe allocate a small percentage to energy or small cap ETFs or both to capitalize on the EU's $750 billion energy buy and the $600 billion business investments. Don't forget to balance that with value stocks to avoid potential tariff volatility or dips in European stocks like we saw it with BMW last week. Maximize the tax savings from the now permanent tax rates. Again, use those to invest in areas where you believe you might see some improvement, or look into a Roth IRA or a healthcare fund. And remember, work with your CPA to make sure your withholdings are correct for 2025. No need to overpay Uncle Sam. Hedge inflation. With tariffs pushing the CPI to 2.7 in June, protect your portfolio with inflation-linked bonds or real estate, which could take advantage of the Section 199A deduction, which we talked about last week for rental income. Diversify globally, but be cautious. The EU deal strengthens the euro, and the Hang Seng is up 23% this year, according to Reuters. Maybe you want to have a percentage in international ETFs. I know a lot of managers who've been avoiding international stocks for the last few years, and those who haven't gotten in to take advantage of the gains this year are falling behind. Remember, always stay diversified. Diversification is the key, but don't overdo it. Don't chase, especially with tariff talks still going on. Stay grounded. Ignore the headline noise that's designed for clicks and ratings. Use your financial model to keep your feet planted firmly on the ground. We use MoneyGuidePro in my office to stress test my clients' portfolios for inflation, for diversification, for volatility, helping to keep your retirement on track. You should be doing the same. And don't forget to check out our website for our 2025 tax savings guide, LeonardiFamilyWealthcare.com. So that's a wrap for this week. The U.S. EU trade deal is a blockbuster with energy and small cap opportunities, but tariffs mean you need a plan. If you don't have a plan, let me know. I'd be happy to help you build one. Don't forget to download our free tax planning checklist from our website. Follow us at LeonardiFamilyWealthcare.com to help retire smarter. We're also on Instagram and on Facebook for timely updates. Ready to secure your future? Schedule a consultation with me. I have a link to my calendar on my website, LeonardiFamilyWealthcare.com. Plan smart, retire happy, and enjoy the last few days of July. Summer's flying by. Next week, I plan on tackling the declining birth rate and what that means for Social Security and the markets. Stay tuned.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.